Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we're diving deep into a fresh analyst report from RHB Bank Singapore that just raised their target price for Singapore Exchange from $13.60 to $14. That's a solid 3.7% bump in their price target, though they're keeping their neutral rating. But here's what caught my attention. This isn't just about one analyst's opinion. This move reflects some fascinating dynamics happening in our local market that every Singaporean investor needs to understand. Let me break down what's really happening here. RHB analyst Shekhar Jaiswal made this adjustment based on trading data showing turnover and volumes running ahead of estimates. The securities daily average traded value has been stronger than expected, and there's a compelling story behind these numbers that goes way beyond surface-level metrics. The timing of this report is particularly interesting because it comes right after Singapore unveiled major measures to boost our equities market in February 2025. We're talking about a massive $5 billion equity market development program from MAS and the Financial Sector Development Fund. This isn't just throwing money at the problem. It's a strategic push to transform Singapore into an even stronger financial hub. What really excites me about this development is how it connects to the broader transformation happening in our market. The government introduced tax incentives during Budget 2025, including a 20% corporate income tax rebate for new primary listings and 10% for secondary listings. Fund managers listing in Singapore now get a 5% concessionary tax rate if they distribute profits as dividends. These aren't small tweaks. They're game-changing incentives that could reshape our investment landscape. But let's talk about what this means for you as a Singaporean investor. SGX has been trading near its historical average forward price-to-earnings ratio, which limits prospects for massive price appreciation. The forward dividend yield sits at 3%, which is below the broader market average of 5.2%. This makes SGX less attractive for income-focused investors compared to other options in our market. However, here's where I see opportunity that others might be missing. The recent January 2025 data shows securities market turnover value hit $20.8 billion, up from $20 billion in December 2024. More importantly, the securities daily average jumped to 1,042 million from 954 million. These aren't just random fluctuations. They signal sustained momentum in trading activity. The derivatives volume also tells an interesting story. We saw 23.9 million contracts in January 2025 compared to 23.2 million in December 2024. The daily average volume increased to 1.24 million from 1.09 million. This consistent growth in both securities and derivatives trading suggests the market infrastructure is handling increased activity well. Now, let's address the elephant in the room. RHB maintains the neutral rating despite raising the target price. Why? Because while the fundamentals look solid, there are headwinds we need to acknowledge. December 2024 results fell short of estimates by 2%, which dampened expectations for the second half of the financial year. Both securities turnover and derivatives volumes declined on a month-on-month basis in December. But here's my contrarian take. I think this temporary softness actually creates opportunity. Market volatility driven by global policy measures like U.S. interest rate cuts and economic reforms in China is expected to sustain trading activity. Singapore's position as a gateway to Asia's growth becomes even more valuable during uncertain times. For CPF investors, SGX presents an interesting proposition. You can invest up to 35% of your investable CPF savings in stocks and REITs, and SGX offers exposure to the financial services sector that benefits from increased market activity. The trailing 12-month dividend yield of 3.2% exceeds the CPF OA interest rate of 2.5%, making it potentially attractive for long-term retirement planning. The SRS angle is equally compelling. With annual contribution limits of $1,300 for Singaporeans and permanent residents, SGX could be part of a diversified portfolio that benefits from the tax advantages of the SRS scheme. The uninvested SRS funds earn only 0.05% interest, so deploying capital into quality stocks like SGX makes financial sense. What really sets this opportunity apart is the regulatory framework improvements coming down the pipeline. SGX Regco is streamlining the listing process, cutting review time to 6 to 8 weeks. They're moving toward a simpler, disclosure-based regulatory framework that should attract more quality listings. The financial watch list is being reviewed for possible removal, which could reduce regulatory overhang. The macroeconomic backdrop also supports SGX's prospects. Singapore's exchange rate strength relative to key trade partners historically has a negative impact on domestic stock returns, but current global dynamics suggest this headwind may moderate. Industrial production and merchandise trade both positively influence stock returns in Singapore, and both metrics have been showing resilience. Looking at the competitive landscape, SGX benefits from Singapore's position as a leading global financial center. The MAS ensures a transparent, well-regulated environment that fosters investor confidence. This regulatory advantage becomes more valuable as other regional exchanges face various challenges. The $5 billion Equity Market Development Program isn't just about throwing money at the market. MAS will invest with selected fund managers who focus on Singapore-listed stocks, encouraging broader investment beyond index components. This creates a virtuous cycle where increased institutional interest drives liquidity, which attracts more listings, which generates more trading revenue for SGX. However, I want to be balanced in my analysis. The global investor program adjustments requiring new family office applicants to invest in equities listed on approved Singapore exchanges could boost volumes, but the impact will likely be gradual rather than immediate. The expansion of the Grant for Equity Markets Singapore to improve research on mid and small cap companies addresses a real need. But research coverage improvements take time to translate into trading activity. If you're finding this in-depth analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. My overall assessment is that RHB's target price increase to $14.10 reflects genuine fundamental improvements rather than just momentum trading. The neutral rating makes sense given the valuation constraints, but I see this as a quality hold with potential upside catalysts emerging over the next 12 to 18 months. The key risks to monitor include global market volatility that could reduce trading volumes, competition from other regional exchanges, and the pace of new listing activity. However, the structural reforms being implemented by MAS and the government create a more favorable operating environment for SGX than we've seen in years. For Singaporean investors, SGX represents exposure to the growth of our financial services sector and the broader Asian economy. Whether you're investing through CPF, SRS, or regular brokerage accounts, SGX deserves consideration as part of a diversified portfolio focused on Singapore's long-term economic prospects. The combination of steady dividend yield, exposure to market growth, and regulatory tailwinds makes it a compelling story for patient investors.